one were to really just try and understand what's happening around from an equity investor standpoint, how should one look at it? I mean, is this primarily an oil story? Is it a rupee story or a risk-off story, given how FPIs have pulled out? And what's going to break the cycle? Just trying to understand what is it that we have at hand to deal with in terms of the nature of the problem.
So Aisha, actually, the event which have unfolded are following up with 18 months of challenges with the Indian equity markets have had. And not in isolation, but particularly in relative terms, when you look at other countries, in the region, whether it's Korea, Taiwan, China, Japan, even some of the global equity markets, they've all done very, very well. And on an 18-month basis, Indian markets have underperformed to the extent of 30-40% compared to any of these markets. And I think already, we have had, I would say, issues with the returns not being made. And on top of it, we have had this instance. But as you rightly said, the first, I would say, it started in 24 when Indian markets actually had become quite overpriced compared to their, regional peers. And we also had a situation where economy did slow down and corporate profit growth did slow down. So September 24, economy slowed down to just over 5% growth. Corporate profit growth came only at 3%, which was the lowest if you remove the COVID period for a long, long time. And, foreigners were looking at investing in high tech, and unfortunately, India did not have too many of those companies. At the same time, companies in Korea and Taiwan and so many other countries had high tech companies, and therefore the money started to flow out of India and went into those countries. And to top it all, we had this huge issue of tariffs being imposed, and for 1 year, every country suffered, and India suffered more because, unlike our expectations, India was slapped with a 50% tariff, which was, India was one of the only two countries in the world which had a 50% tariff, other than Brazil. So I think we have had a combination of a lot of rough things. Things were actually panning out pretty well finally in January or February this year. A combination of income tax cuts, GST cuts, saw growth come back. RBI, the central bank, was up there. We reduced our interest rates, we increased liquidity. Corporate profit growth was finally showing signs of improving. December 25, we had the first time in 7 quarters that earnings came better than expectations. The broader market earnings, mid-cap and small-cap earnings, were upwards of 15-18%. And even on the tariff front, we finally had US cut India's tariff to 18%, and then with the Supreme Court of US knocking off the tariff, issue, I think we were back to 10%, and there also growth was looking good. I think this conflict has come at a time when things were finally looking, better for Indian equity markets over the next couple of years, and I think that is why the pain is much more. Now it's all connected. Oil goes up. Obviously, there is going to be pressure on India's foreign exchange. The rupee went up. Foreigners selling only increased in the month of March because there was a big risk off. And I think a combination of all that led to one thing after the other. I think as we speak, hopefully there is stabilization. Rupee, because of actions taken by the government, at least for now, has stabilized. Hopefully, if there is some resolution to the conflict, there is a straight $20-25 of reduction, which we expect on the crude oil price, because, even if you look at August delivery, for example, we can buy oil $25 lower than the current prices. So it all hinges in the near term to this conflict getting de-escalated. And that's $1 million question. But I would stick my neck out and say that 90% of the issues pertaining to the conflict are already discounted by the markets. And from here on, I would say the risk reward is very, very much in favor.